Hey everyone, welcome back to another episode of the Free to Go CFO podcast, where we dive deep into conversations about scaling a profitable D2C brand. I'm your host, Jon Blair, founder of Free to Go CFO. We are the go-to outsourced finance and accounting firm for 8- and 9-figure D2C brands. All right, today is an exciting day. I've got one of my Free to Grow CFO team members on the show today, Prabhu. I'm going to get this maybe slightly wrong, Prabhu. I'm sorry, but Prabhu Shrotre. Prabhu, thanks for coming on, man. How are you doing today?
I'm doing good, man. How are you?
I am good. Let's see, what time is it where you're at? It's 8 a.m. here. What time is it there?
It's 7:30 in the evening here. So, yeah, it's
Well,
good.
I appreciate you joining. For those of you that don't know, we have a small team in Pune, India. Prabhu is on that team, has been with us for a while now. There is, 3 people on the team now out there?
Yes, we have 3 people in the team here.
Yeah, so Prabhu has been a steady force in our business for a while now. Has it been 2 years?
It has been 2 years now.
Yep, 2 years. Yeah, it feels like I can't remember Free to Go before Prabhu, so it's hard to remember pre-Prabhu. Got a couple other really amazing people out there as well. But Prabhu, before we dive into talking about probably mostly cash basis accounting and the importance of accrual versus cash basis, can you just give everyone just like a really quick overview of what you do at Free to Grow CFO?
Sure. So, I'm Prabhu. Thanks for introduction, John. And the things that I do in Free to Grow is presenting the historic books to the clients, that is, recording books correctly, properly, maintaining their books of accounts, and preparing their financial models for the client. So, that's an overview of what I do in Free to Grow.
So Prabhu has seen his fair share of bad books that we inherit when we have new clients come on. Prabhu's been involved in a number of cleanup projects as well as a number of onboardings, which inherently in onboarding oftentimes there ends up being at least a small amount of cleanup. But today we're going to talk specifically about the dangers of cash basis accounting as opposed to accrual basis accounting, which is the way that we do it at Free to Grow CFO. And there's 3 specific areas we're going to dive into. 1, revenue recognition, 2, cost of goods sold, and 3, operating expenses. So Prabhu, let's start with revenue recognition. Can you explain a little bit about the cash basis revenue that we tend to inherit from new clients and why, and some of the areas that the cash basis accounting is misleading or incorrect?
Sure. So what happens is most of the e-commerce brands, they record their revenue as soon as the money hits their bank accounts. And what happens is in the initial phases, the founders think that they're making big profits due to a lot of cash flowing into their accounts, whereas the actual picture, it's not right. And in accrual basis accounting, what we do is we record revenue in the right period whenever the item was sold. So the biggest problem I can think about of cash basis accounting is we only record revenue when the money hits our bank account, we record it as sales, but we tend to forget important concepts like discounts and refunds, which can affect the margins of the brands if they're really looking at having the correct picture of their books of accounts and how much they made in a particular month.
Yeah, so to go a level deeper, can you explain why when you see a brand that's doing cash basis revenue accounting, can you explain a little bit why discounts and refunds and some of those things are missing from their entries?
So what happens is these brands tend to record only the amount of sale as, for example, $100 hits my bank account and I record $100 as sales. In reality, my price of product is maybe 200. I offered $50 of discounts. I had some $50 of refunds. And whereas my actual sale for that period is gross sales of 200 versus net sales of 100. And if we only record the amount that's coming to my bank, then that's obviously not the correct picture what I'm looking at.
Yeah, and even worse, there is even potentially a balance sheet item in that deposit as well, right? Being sales tax collected, which is actually a liability, and then also too an operating expense, or I guess what we call variable order costs, being the Shopify fees or the credit card fees. So as you pointed out, we're missing the bifurcation of gross revenue minus discounts, minus refunds, maybe plus shipping income, right? And then sales tax collected, which should be on the balance sheet, and then credit card fees or merchant account fees, whatever you want to call them, which should be an operating expense that's not in the revenue. section of the P&L. So let me, I think it would be helpful if you explain, because a balance sheet item in sales tax collected is embedded in that, quote, I'm going to say air quotes, like revenue that they're recognizing, and also potentially an operating expense or a variable cost being the credit card fees. What does that do? This form of cash basis accounting, where they're just plugging the net deposit that hits their bank account to revenue, what does that do to analyzing margins?
So it's a really, really messed up thing when books are recorded on cash basis. So as I said, like if we record revenue when the money is hitting my bank account, for a period, I might think I'm generating enough sales, but I should be aware that some part of my sales is not actually sales, but some part of my cash in is related to sales tax or gift card liability that I'll have to pay in the future
Mm.
period. And if I'm not accounting for that correctly, I might not have a picture of what liability is coming up in the future. And in the future, I might not have enough cash balance to pay that. So that's an issue that most of the brands are facing.
Yeah, so there's actually, as you're talking, there's three issues I can think of. There's probably more, but one, you have the income potentially in the wrong period because sales that actually got fulfilled at the end of the previous month, that deposit's delayed and not showing up at the bank account for a few days. So you have the revenue in the wrong period. Then two, what you brought up, some of that quote income isn't actually income. It's owed to someone else. It's either owed to the government because it's sales tax, or it's owed to a customer in the future because it's a gift card, which is technically a prepayment and is not income. So we're overstating income there, but then we are also understating income by the amount of the credit card fees, right, that are subtracted, that should really be a variable cost. So if we use that, let's say we use this net amount that is deposited to the bank account as your quote net revenue for margin calculations, which is like margin dollars divided by net revenue, the denominator is wrong. If the denominator is wrong, the percentage you're calculating is wrong. And so it really causes all kinds of issues. So I guess the point, though, I want the audience to take away, it's not just one thing that it causes issues with, it's multiple things. And if you start talking about really important questions like, can I afford to scale ad spend? Is my ad spend profitable? Really, really hard to do when you're doing this incorrect cash basis revenue. So let's move on next to cost of goods sold. What's the big issue that you most commonly see with cost of goods sold accounting?
So most of the brands that come to us for the first time, we see that the accounting policy they're following is they record the purchase of inventory as an expense whenever they pay money for it. But in actual sense, if we look in correct accounting sense, it's not actually an expense, but it's an asset. It only becomes an expense when you sell the goods. That's when it moves to COGS. Until that, you have to record
Mm.
it as an asset, inventory asset. But most of the brands fail to maintain that accounting policy, and they have a negative, or I will say an artificially low income in the period when inventory is purchased. And when the sale actually takes place, they have this artificially wrong profit since expenses booked in the previous period.
Yeah, so there's actually a commonality between the revenue recognition issue in terms of P&L value in the wrong period, the wrong accounting period, the wrong month. There's a commonality between that and this cash basis cost of goods sold issue that you're mentioning, which is that in one period, your profit will be overstated, and in another period, it will be understated. And so what's interesting is, generally speaking, and this is a trap, so like don't follow this. Don't try this at home, listeners, okay? But like you can look at a longer time horizon, let's say trailing 12 month, to get a rough idea of what profitability is, because those month over month swings can kind of like offset each other and smooth each other out. But that's a trap. Why? Because I can't tell what happened last month or the month before or the month before. So I can't follow trends on a month by month basis in real time. And so let's use cost of goods sold as an example. I want to know if my gross margin is getting better or worse every single month, not just on a trailing 12-month basis. And you cannot do that accurately if you have revenue being recognized on a cash basis and you have cost of goods sold being recognized on a cash basis. I think furthermore, Prabhu, what about like, why is it important? Let's remove the P&L for a second and let's not talk about the timing of cost of goods sold hitting the P&L. Just the
Mhm.
balance sheet. Why is it important, or what are some of the reasons that come to mind for you of why it's important to get the asset value correct of inventory from a balance sheet health analysis standpoint?
All right, so that's a really good question, John. It's really important to have the correct asset value on the balance sheet because we calculate several ratios like inventory cycle or cash conversion period, which are broadly linked to our working capital cycle. And if we are not getting that number correct, owners might get in trouble if they don't have this correct amount of cash that they require to pay in the future, or if they're not able to assess their proper working capital cycle, then that might cause an issue.
Yeah, well, and so it's not just that what one thing that our books do when we get them done right, the free to grow way. The P&L is obviously important. It's a critical starting point for financial analysis. But the balance sheet in an e-com brand that is capital intensive because it holds inventory, the balance sheet is just as important, maybe more important, because you can have profit but no cash. How is it possible to have profit but no cash? Usually it's because you have too much inventory on hand, and your CFO or your finance team can't help you manage the financial impact of inventory if it's not recorded on the balance sheet accurately every single month. You can be profit rich and cash poor because all your cash is sitting on the balance sheet in the form of inventory. So it's actually just as important. On the flip side of the balance sheet is accounts payable. And actually, I want to segue now into talking about cash basis operating expenses. And we'll talk about the impact of accounts payable and how that affects working capital analysis. But what do you most commonly see, Prabhu, as issues with operating expense accounting when we take on a new client?
So on the front of operating expenses, I see that most of the brands, similar to revenue, they also record their operating expenses on cash basis. So to look at this as an example, if I go to a restaurant, I eat something, I pay through my credit card, and then my credit card bill is paid 45 or 50 days later, then that 50 days later is when money is going to go out from my bank account. These brand owners, they record the expense on that 50th day, but not on the day when they consume the food. So isn't really expense that took place on the day when you ate the food and not on the 50th day. So that pretty much applies to expenses as well. For example, ad spends. Ad spends which are charged to credit cards are usually taken out of your bank account on the 40th or the 50th day. And brands look at it as the brands don't see the growth of sale, and they cannot have a proper correlation between the sales that are growing up and the ad spend since it's not recorded in the correct month.
Yeah, so if a brand we see this with brands that have payment terms with, say, Facebook or something, and if we don't get the bill from the brand, which specifies the period that ad spend was for, it's hard for us we can run the risk of booking the expense when that bill gets paid to, say, Meta. That's usually why I think I see an issue with other bookkeeping firms getting the expense recognition wrong on a cash basis, is because they don't have a process set up to get the information needed from the clients to figure out the proper expense, the proper period for some of these big expenses. Now, a lot of our controllers on the team are trained to look for some of the big expenses that maybe need to be accrued, which means, like, even though we haven't paid for it yet, we book the expense in the month that expense is benefiting. We see this a lot of times on the marketing expense front, needing to book a marketing accrual. Sometimes we see this on shipping costs as well, shipping to the customer, because you'll get billed by the 3PL late, like in the month after the shipments actually, benefited the company. And so this is like super, super key. I think another big thing, in general, coming up with a process to get bills from our clients as opposed to just booking expenses on the bank feeds, right? Which is the month that
Right.
the day that the cash comes out of the bank account, or the day that the expense hits the credit card. That is the key, is coming up with a process for that. And again, going back to tie a thread between revenue recognition, COGS, and operating expenses, if you have revenue recognition, that is the wrong amounts and partially in the wrong periods. Cost of goods sold on a cash basis, that is being expensed in the wrong period. And then also operating expenses, you've just got revenues and costs all over the place in different months. And it starts to become basically impossible to analyze your financials. Okay, Prabhu, so there's another thing related to operating expense accounting on a cash basis that affects the balance sheet. I see this a lot when I do our CFO audits. It's that there is no accounts payable on the balance sheet, which immediately tells me operating expenses are on a cash basis. Can you just really quick share with the audience why having no accounts payable on the balance sheet when there actually is money owed to vendors at the end of every month, why that's an issue?
So what most brands do is they tend to book the expense when the money actually hits their bank account. But in reality, they actually owe their vendors. And during this process, the accounts payable is not booked on the balance sheet. And that's a big red flag because when computing the working cash flow cycles or calculating the future working capital requirements, if we are completely ignoring the accounts payable, then there's a hidden liability that we are not accounting for. And from a cash point of view, it can just drag down, brands when the liability pops up and we have not planned for it accordingly or beforehand. So that's a
Yeah,
big red flag.
when I as a CFO look at the balance sheet and I look at cash position, I don't ever say, hey, like let's say the cash balance is $1 million. I don't ever say we have $1 million in cash. I always say we have $1 million in cash minus 100,000 in credit card liability minus 250,000 in accounts payable. And if there's any other current liabilities on the balance sheet that I know need to get paid in the next 30 to 60 days, I subtract those and say, here's how much cash we have net of what we owe people over the next 30 to 60 days. And if you don't have accounts payable properly accounted for on the balance sheet, then you have no way to track that you actually owe some amount of money to your vendors. And you can't assume that all the money in the bank is yours because there are short-term liabilities, accounts payable usually being one of the biggest ones, that your other people have rights to, and you need to be able to understand that when you're doing cash flow and working capital analysis. So this was an awesome conversation, Prabhu. I think this is going to be really helpful for our audience. I want to ask you one final question that doesn't have to do with accounting, and it's about working at Free to Grow CFO. What about working at Free to Grow CFO and our culture makes you want to work here and kind of drives forward a high level of performance across the team?
Man, it's really difficult to answer or really difficult to give just one point that to convince me that I need to work at Free to Grow. I have so much of freedom working here. And just to express how much freedom I have, I recently traveled to the US to visit my family, my brother who stays there, and that did not at all my work at all. I mean, I moved there, I stayed there for a month, and I worked just as usual. So that's one good thing. The other thing I would say, the owners, the all the teammates, the owners, everyone in the team is so supportive and so knowledgeable, and it's a really challenging environment to work with everyone. And I'm just like happy to be working every day. So it's never a dull day at Free to Grow. I would say every messy client that comes up is a new experience for us. Yeah,
I love
that
it. Yeah. And we love having you on the team, man. Having you come on the podcast, I feel like is a big milestone to have you come on and chat through how we help brands not just fix their accounting, but really fix their decision making. And the things that you talked about today are basic blocking and tackling, foundational fundamentals that are absolutely necessary to scale a D2C brand fast and profitably. So I appreciate what you're doing, Prabhu. I appreciate you coming on the podcast, and I look forward to chatting again soon.
Thank you, John. Thank you for having me over. It was really lovely to be on this, and thank you. Thank you for having me.
Awesome. Don't forget, if you like today's episode, please hit the subscribe button and leave us a review. It helps us reach more people like you. Also, if you want daily tips on scaling a profitable D2C brand, follow me, Jon Blair, on LinkedIn. And if you're interested in learning more about how Free to Grow CFO can help your brand increase profit and cash flow as you scale, check us out at freetogrowcfo.com.